So we have another quote for you to start off our next segment on our foundation building for our trading system. And that says the safest way to double your money is to fold it over and put it in your pocket. And that kind of goes to where we're going to go on this segment again as we're building our foundation in this trading system. Our foundation has four components: chart patterns, technical analysis, capital management or money management, and the psychology of trading. In this video, as our quote implied, we're going to focus on capital management, money management. So the obvious question is, what exactly is money management? Well, what most traders may or may not realize is that when you enter a trade, you're accepting some type of risk. Now, of course, to the detriment of many traders is they don't realize that. The other detriment is that many traders always believe that they're going to be right, so therefore they don't see the risk in the trade. And we can define risk as the maximum amount of money that you could lose on any given trade if it goes against you. The maximum amount. Whereas the risk tolerance is your ability to stay in the trade as it goes against you. You're acknowledging that there's a risk in this trade and it can go against you for a period of time or a certain level. However, the risk is the absolute level, the absolute price where you're saying, I can no longer tolerate this, I need to get out of this trade. Now, one of the things I like about Robert Kiyosaki is he says that in Rich Dad Poor Dad series is that a defined risk, a risk when you know the rules, is not necessarily risky, it's an educated decision. So when you define your risk and you know what it is it really a risk or is it the cost of doing business? That's one of the things you have to start realizing as a trader is you have to pay a cost. Sometimes when you enter a trade, being stopped out, reaching your risk level is just the cost of doing business. So the question is, do you have an understanding of your own tolerance? Do you have an understanding of how your comfort level with tolerance and with risk determines your success in trading? How many times have you gone out of a trade and as soon as you got out, it went in your direction? Now, did you get out at a defined point and consistently you always get out there, or did you get out because in this particular trade, your emotions started getting in and you got out of the trade? Happened to me today. But it was a defined risk where I got out. Which is a good point of saying, even when you get out at a defined point, the trade can still come in your favor, and again, it's the cost of doing business. So when you set and more importantly accept your risk for each trade, you're now allowing yourself to protect your capital, calculate what is the best position size for each trade, but more importantly, you've defined an exit point. You've defined where your risk has been met, and you now need to exit that trade. Again, I ask, do you know the exact amount of risk that you are accepting with each of your trade? For each and every trade, you must identify your risk for the trade, and we can do that by 4 simple rules, and they're obvious. Where's support on the trade? Where is the resistance on this trade? Where's my target if I get in? And more importantly, where's my stop? Where's my risk if I get into this trade? If you can't answer these questions, I'm going to ask you, why did you get into the trade? Some common misunderstandings that traders have with regards to capital management, money management, is focusing so much on the entry or the indicator that they have and not as much as on their stops and their targets. Now, keep in mind, most of you know I've been involved in real estate for a long time, and I do believe that you make your money on your buy. If you get a good entry, you have some more room to negotiate for the exit. You have some room that you can kind of massage a little bit and get out at different prices and still lock in a good profit. So I understand the importance of the entry, but you also have to keep in mind your risk. Where's your stop? Where's your target? What's your risk to reward ratio? Because if it's not a good risk to reward, why are you even getting into this property or trade? And also we have a lot of traders who are trading much too large a position. That might be based upon their account size. They only have $300 and they're trading a $300 margin account, whatever. Their experience level. They're doing advanced trading strategies. options, forex, selling premium, when they don't really know what to do. More importantly, when the trade goes against you. A good example of that would be credit spreads, and they are a safe investment vehicle with options. But what do you do when the credit spread goes against you? Are you going to do a butterfly and roll into another one? The other thing is traders don't keep in mind their comfort level. Um, when you buy a system, did you buy that system based upon your comfort level? See, so often you follow the guru to guru and you buy their system and you enter the trade here or there, but more importantly, you don't take every trade that the system requires because it's not comfortable for you. You don't put your stop where the system requires because it's not comfortable for you. So did the system fail or did you fail the system? I was watching a webinar by TradeObjectives.com the other day, and they talked about the ability of a trader to make objective observations and decisions based upon the market is severely hindered when they have too much at risk in a trade. How many times have you had a friend in a bad relationship, and you're telling them she's no good for you, or he's no good for you, but they can't see it because they're in love. In the moment of that love, in the moment of that relationship, they can't see that it's a bad relationship for them. Especially abusive relationship, whether it be physical or mental. When you're in the midst of it, it's hard to see it. And we all have the wonderful backseat driving ability, or the wonderful ability of hindsight 2020 when we get out of a situation. Well, it's just like that in trading. When you're in the trade, do you get into that tick for tick battle? Everything is telling you to get out. Or more importantly, your emotions have taken over and you block out everything that tells you to get out, and you only see the things, the ticks in your favor, that tell you to stay in the trade. So where do we go? Or where are we going wrong with these misunderstandings? Do you even have a trading plan? Or are you just trading the trade? Are you trading a buzzer? Are you trading a newsletter? Do you have a trading plan? There's nothing wrong with a buzzer. There's nothing wrong with a newsletter. But you have to be able to make your own educated decision about whether or not that's a good trade for you. And more importantly, if this is the place where you want to get in that trade. Again, we keep saying that word risk. You're taking on too much risk. Way too much risk. The kamikaze, I'm staying in this trade until it turns positive. You have no discipline. You have to wait until all of your criteria, your setup actually sets up. That could be at 9:35 right after the bell opens. It could be at 10:30, the 10:30 reversal. Or it could be at 2:30, 3:30. Can you sit and wait for your trade to develop, or are you going to force the trade? Are you going to wait for low stokes, or you're going to say, I think it's going to go without me. Remember, live the trade another day. There's always another trade. That discipline and patience fall in the same category. Maybe you have a too small account for trading your particular system. And I'm a firm believer in small accounts. I've been there. We've all been there. And I think it's unfair for people to say you should have $25,000 to trade one contract or whatever it is. That's like saying, I've got a daughter. I got a beautiful 9-year-old daughter. And that's like, and I have a son. But more importantly, I'm going to focus on my daughter. I'm going to be stereotypical here, ladies. Don't be mad at me. Should I be blind and think that she's never going to be in a relationship and never possibly have a physical relationship? And tell her absence is the only way? Or should at some point in time, I at least educate her about some options that she has about birth control and safe sex and all those other things? My point is this, let me bring it together for you guys, is that sure, should you have $20,000 to trade in one contract? Sure. Should you abstain until you're married? Sure. But the reality is there are people out there who are not. And so we have to also educate those people about ways to get into the market. I'm a firm believer that futures is a great way to do that. But you have to do it sensibly. What about people who adjust their stops? Ooh, it ticked in my favor a little bit. I'm going to move it now just to give it some more room, and you move it to a bigger loss. You're adjusting your stops for the absolutely wrong reason. So Since we're talking about stops, and since we're talking about money management, I think it's time for us to go ahead and start looking at some key vocabulary for money management. First and foremost is stops. As we talked about, the stop is your key risk level. It's the decision point where you're saying, I no longer want to be in this trade. This trade's not working. My risk has been met. Trailing stop is just the ability to use stops to lock in your profits. They can adjust on the price as your trade is moving in your favor. Locking in profit, locking in capital. And position size determines how much are you going to get in. What is the dollar amount you're going to put at risk on each trade. So again, let's take a look at stops. In our example here, we have number 2 is where we're going to get in a trade. We have 2 targets at number 1, and then we have our stop at number 3. The stop is the order of buy to sell when the price passes our defined level. Our risk level is at number 3. If it passes through number 3, we want to get out of the trade. We can use stops to lock in our profits, or more importantly, live to trade again. It limits our loss. And it can dramatically affect your overall performance odds of a trading system. If you have too tight of stops for the system, then trades that might have worked had you had a 20-point stop instead of a 10-point stop might have worked, but since you were stopped out, you didn't get a chance to see whether or not it worked. Again, do you have a trading system that fits you, or do you just have a trading system that you found on the internet? What about trailing stocks? Well, we already talked about they allow us to let our profits run and cut our losses, but more importantly, as the stock's moving in our favor, it allows us to maximize our profit. And I'm a high favor of trailing stocks. Why? Because it eliminates our emotions and let it be programmed. Some people like to raise their stops. That's great, and there are times where I do that too. But a trailing stop, again, takes the risk out of your hand and allows it to be computer. In the example here, we can see where we got into our trade, and we can see the red line continually moving higher as the stop is moving up, as the trade is moving in our favor, and then we get stopped out because it did eventually come down to a price as we're trailing higher. We usually determine a trailing stop either as a number of points or a percentage in relation to the price of the vehicle as you enter the trade. Position sizing. This, I have to say, has been probably one of the most overlooked aspects of trading. Again, as we said before, it tells you how much or how big your position you're going to take on each trade. And it's overlooked time and time again, and it's one of the most important aspects of trading because, again, are you taking on too much risk for on your trading? Good position sizing can allow you to take a negative trade and making positive. I know a lot of people may have different opinions about averaging down, but when it comes to futures, if you have good position sizing, you're not going all in at the beginning and you average in properly, then you can take a potential losing trade and make it profitable. And that's why position sizing is what professional traders do and what losing novice traders do not. Again, position sizing answers the question, what percentage of money should I place into one investment or one trade? I'm going to go back to traderjector.com and share what they talked about when you look at position sizing that are too large. Well, obviously, they're going to increase your risk to ruin. You're going to blow out your account because you're trading much too much, and it's going to affect you emotionally, and you're going to stop out sooner than you want to because you see how much it's going against you and not let the trade run. And because you're losing too much money, then your recovery becomes much more difficult, and the emotional cost is huge because your recovery is taking too long. Now, for position sizing too small, there's some positive here. It limits your profit potential, but it also limits your loss potential. And therefore, it allows for you to have long-term survival, which means you may have time to refine your system and maybe find the right position sizing. But again, you're not blowing out your account, and therefore, your emotional cost is less severe than when you have a large position size. Now, when we have the just right position sizing, it respects your risk comfort level. You're not shaking over the trade. It's just right. It's an acceptable amount of tolerance, acceptable amount of risk. And more importantly, it allows you to survive when you have a string of losses. Because remember, you're not going to hit a home run every time. You're not going to hit a single every time. You are going to strike out. The key is with position sizing and capital management and stops is living to trade another day. Live to come back up to the plate to swing again. So there are several types of position sizing methods that we're going to talk about. There's 4 types. We're only going to focus in on 3. There's a fixed position size, which basically means for each trade you take the same position size. A fixed fractional is when now for each trade we're going to take a percentage of our account value for each trade. A fixed ratio is where each contract has to earn a certain amount of money before you're allowed to trade more money in that investment style. And then there's the volatility base, which is based upon the average true range of the vehicle using. We're going to focus on the first 3 in this video. So let's begin by taking a look at fixed position sizing. Again, in this example, in this methodology, no matter what type of position you enter, you always take the same size. 5 contracts, 10 contracts, 20 shares, 100 shares. No matter what you're buying, you always use the same amount of shares for each trade. So let's take a look at that. What if you're long MVIS? Well, it's about $3 right now. We're going to use a 5% stop, so that's about 15 cents. So our risk in this is $15, total investment $300. What about United States Steels, X? Well, that's around $42 right now. If we use a 5% stop, that's $2. And now we're risking $200 on a $4,200 capital investment. And my beloved Apple, well, what if you went long at around $270? And now your 5% stop is about $13 down to $256.50, and we're risking over $1,300 with a $27,000 capital investment. So the question is the risk for each of these trades equal? Well, obviously the answer is no. We can see that $15,200, $1,350. Now, if you were to reverse this and change all the stops to be at $100, that also wouldn't be a fair trade because the movement, the average true range on these stocks is different. You put us a $1 stop on Apple, you're going to get stopped out. Same thing with United States Steels. Eventually, MVS, you'll be in the trade a much longer. So you can see that there are definitely some flaws with fixed position sizing. Not to mention that a stop out of Apple could ruin all your profits on MVS and X because the risk is so much more that it can, one bad risk there could eliminate all your profits on another trade. So let's go ahead and take a look at another formation of methodology of position sizing. So let's move on to fixed fractional method. This is another form of position sizing, and it's probably one of the most common methods that we can use to equalize risk. It's usually computed by taking a percentage of your total account value, and thus it's very effective and simple to use for all investment vehicles, stocks, options, and futures. So typically what you see, one developed by Dr. Alexander Elder, is 2% per trade, and yet you're not supposed to take 6% of your total account value. So each trade can only be 2% of your total account value, and all of your trades add up together, it can't be more than 6% of your total account value. So let's say we have $50,000, and we are willing to risk 2% per trade, so that is $1,000. So if we wanted to buy a stock at $53, and we want to put a stop at $49, we've now defined our risk, and that risk is $4 a share. So we would know how many shares to buy by taking the amount we're willing to risk, $1,000, divided by the stop of $4 to come up with 250 shares that we need to buy. The advantage of this strategy is that no matter what, the dollar risk is the same. Your account does not know or care where the money came from, so we're equalizing the risk, and more importantly, because you're defining the risk, in this example, a $4 stop, you're now trading within your comfort level, your comfort zone. Again, we're looking at 2% per size per trade and 6% total over your whole account value. The last position method we're going to cover is fixed ratio. This was a method developed to equalize our profits that are required to graduate to the next size level. It was popularized by Ryan Jones in The Trading Game and Dr. Van Tharp in Definitive Guide to Position Sizing. And what do I mean by this whole concept of graduating to the next size level? If you have an account, I don't know, around $25,000, and you were trading one contract, your target would be $5,000. When you get that $5,000, you're now up at $25,000. You're now allowed to use 2 contracts. But your target is still $5,000. So once you make another $5,000, you're now using 3 contracts. And the target remains the same, 1, 2, 3, 4, 5. What will change is that you should achieve your profit target faster because you're using more contracts. However, your profit target does not change. So what do all of these position size methods mean? Which ones are the best? Well, Dr. Van Tharp in Trade Your Way to Financial Freedom kind of did a little experiment with all of these position sizing methods. He took $1 million, traded them over 5.5 years at about 595 trades. And what were the results? Well, the worst one was the baseline method where he took 100 shares and traded over and over again. That was the fixed position size method. That just returned a little over 0.5% of $32,000. Then he went to 100 shares, also another sort of a twist on the fixed position sizing. And this time he was able to return 5% and get to the $237,000 on the $1 million. Next, we went to a fixed fractional model. And in this one, he was able to make a 3% turn, and he was able to return $231,000 to his initial investment. Next, he went with the fixed ratio, which was a percentage of the account value. And here you can see he turned almost 21%, $840,000. But remember, it was originally $1 million to begin with. So that certainly seems beneficial. And then our volatility model had the best return at 22%, returning over $1 million. Now, I know you may say, well, you didn't talk about volatility. Because, again, it is an advanced strategy. You have to work your way up to that. And I think you really should focus on the first 3. Remember, the first 2 are the keep it simple models. And then the third one, the fixed ratio, is one that has a little bit more nuance to it. And then you can grow your way into this volatility-based position sizing. But what's important here is that, remember the experiment. Each method had $1 million. Each one took a different position size. Each one returned a different account growth, return on investment. So you can see that based upon the methods that you use for position sizing can help the longevity of your trading and your capital. So what's our review? How do we want to end this on money management? Well, the first thing you have to do is accept the fact that every time you take a trade, you are taking on a risk. And it's important that you use money management to protect your capital and profits. When you are defining your risk, it's important that you define your risk in a place where you're still in your comfort zone. Every trade is different. You need to compute your stops, then your position size, and that will equalize your risk. We all know the golden rule of trading. No one's not do unto others as they do unto you. It is cut your losses short and let your winners run. Live to trade another day.